Hello and welcome to today's show with myself, Josh Mahony, Chief Market Analyst and Senior Market Analyst, Mohanad Yakout over in Dubai. We're going to be talking about a whole raft of different topics in some of these new video formats for you guys. And today's topic is all about whether July's boom for equity markets in the US is leading us to a period of potential weakness or sideways consolidation for the S&P 500 and US stocks. So we're going to go through a handful of different things that are kind of playing into our minds right now, discuss them and see exactly what we're thinking about, whether they might or might not impact sentiment. And part of this conversation comes around seasonality. You've been seeing a lot in the news recently about the idea of July being the best month for US equities. And where does that leave us? Well, it leaves us in a 2-month period where historically we see consolidation, right? So August, historically 50% of the time we're up, 50% of the time we're down, and on average we go nowhere with 0% return, right, over the last 20 years. So that means that we've got to question whether we're going to see that same kind of thing playing out once again. As you can see here, sideways price action. Do we care that much about seasonality, Mohanad? Do you look at these kind of things? Do you look at seasonality charts and think, oh, every July this market goes up and therefore I should buy? Or is it something that you just think, well, it depends on the market environment at that time?
I basically am not a big fan of, I'm not a big believer of seasonality. I just look at it just out of curiosity to know what might be the top performance for this month and so on and so forth. However, I believe that market dynamics really change. What matters or what concerns the market right now in this year in August is totally different than what concerned markets last August. So it's just that if you already have some sort of direction or analysis, it might give you that extra confirmation like 10-20%, but of course it's not something to build your own whole analysis on. So yeah, this is just what I believe on seasonality. However, there are things that basically there are times when seasonality applies, especially when it affects the human behavior. So yeah, volatility is usually low in August, and markets absolutely do nothing in August. This is historically not because of anything, but because of the trading liquidity is usually low during the months of summer. So if we are in summer right now, I believe that we might see some low trading liquidity, which might mean that we can see big moves in either direction, either high or low. And this is why markets are really, really sensitive to news during this period.
Exactly. Yeah. I mean, I guess whenever I think of seasonality, I'm always thinking about some markets always feel like seasonality might make sense in particular. A lot of the time it is, like you said, talking about this idea of people are back at their desks or leaving their desks and what might that do in terms of performance over that period. Another way I always think about it is, there are seasonal factors when it comes down to commodity markets in particular. There's times when people sow their seeds and times when people cut their crops down, and maybe you see bad crops or good crops and things like that. So I would pay a bit more attention on that side of things. Same kind of thing with oil, right? At certain times of the year where you see drawdowns in terms of inventories, and certain times when you see buildups, and therefore it's going to impact prices as a result. Notably, when we're talking about that outlook in terms of how it performs in different periods of time, generally the weaker part historically has been the beginning of August. So out of the 2-week periods, this is according to Goldman Sachs, if you take 2-week S&P 500 returns, it's actually the first half of August that generally doesn't really go anywhere. And actually, historically, the second half of August does go somewhere. And given the fact that we're already a week in, well, maybe we have another week of downside or consolidation or you name it, and maybe the bulls come back into play soon enough. Part of the narrative around why you might see weaker markets or jittery markets came from Friday's jobs report. Of course, you're quite used to looking at jobs reports and saying, oh, unemployment went up or down or sideways and payrolls went up or down or whatever. We're not used to seeing absolutely humongous 258,000 job revisions to previous numbers. And a lot of the time, people don't really care that much about revisions. That's what we saw last time, as you can see here. Again, thanks to Goldman Sachs, the split for that revision is sort of half between private and public payrolls. But all in all, it sort of starts to tell a picture of a US jobs market that is nowhere near as strong as we might think. And so people, take their lead in terms of what that means in terms of the outlook for monetary policy. But the question here, if you're looking at potential reasons why markets might roll over, I guess would be an idea of that suddenly the US economy is in trouble. So is that something that right now you're fearful of, or you just think, look, it's been a period of uncertainty, there's weakness because of that uncertainty, and soon enough things will pick back up?
I think the weakness in the latest NFP report is way beyond any short-term uncertainty, and it shows that there might be a big fundamental reason behind this. Because when we look at the numbers, the 3-month average for the new jobs added during May, June, and July, we're talking about a rough estimate of 35,000 new jobs per month. Those numbers, we haven't seen them in the US economy since prior to 2007. So weak numbers. Because when I also look at May numbers, which has already been out and revised twice, so probably won't be seeing any revisions. 19,000 new jobs only in 1 month is a big issue. And yeah, we normally, if we're going to talk about seasonality, we normally see some weak hiring activity during the months of summer because people are out on vacations and so on. However, this is way beyond this seasonality effect of weak hiring. And it shows that maybe, there is a lot of fear when it comes to the tariff jitters and, what will happen and what will not happen and so on. So I would say the Federal Reserve would have a much better job if he was just dealing with inflation numbers and the jobs numbers, but now giving this a lot of uncertainty added again to the US economy because of tariffs, because of geopolitical tensions and so on. So I think the Fed is in a really, really hard position at the moment.
Yeah, definitely. I mean, look, ultimately, it's easy to see tariffs as being detrimental to other countries, right? And great for US companies. But the weakness that we're seeing highlights the fact that this brings inherent concerns for businesses even within the US, because many of them will be importing goods that are very cheap and selling them on at a higher margin, right? So you're actually hurting those US businesses as well. And therefore, those businesses might not necessarily hire to the same degree because, okay, there's the uncertainty of tariffs, but tariffs seem to be certain right now. Every deal that's struck comes with tariffs. And whilst you are seeing these big pledges for investment, whether they come to fruition or not, who knows? But alongside that, you've got the fact that they are very targeted, right? They might be like, I'll give you $500 billion for energy. That's not going to help your shoe company in California that buys something from Vietnam and sells it at like 10 times what they're buying it for. So Boeing might be all right because they have huge new orders, but most businesses won't be helped along that way. And that's why you're seeing a lot of disruption to the US economy, even though apparently these trade deals favor the US. In terms of the market reaction, it's been incredible because people are now suddenly just thinking a September rate cut is guaranteed. They're thinking now the most likely outcome is going to be 3 rate cuts out of 3 meetings. Now, I say the most likely out of these different options, it's the one that's got the most, but it's actually a 45% chance, according to the CME, that this is expected or priced in for. So in actual fact, there's still 55% chance that we see 2 or less. But that growth that we've seen is evident on this chart here, because as you can see, just a week ago, that figure was closer to sort of 10%. Now it's 45%. So markets suddenly very, very dovish, very confident that we're going to see action from the Federal Reserve. It does kind of overlook the reason why the Federal Reserve were holding off. Yeah, part of it was the inherent strength in the US and that they felt that maybe they didn't need to act. And that's what the jobs market is sort of pushing on. But the inflation side of the picture, that's not necessarily resolved. We can see here in terms of sort of a breakdown in terms of the US inflation outlook. On the monthly basis, we have seen it gradually picking up. And this is notable because next week we have the CPI reading out of the US. So that confidence towards the idea that the Fed are definitely going to act, and it probably is likely they will act in September, but then they'll just keep cutting meeting after meeting, ignores what had been building up recently. That is, when we see these inflation reports, despite the fact that they're not massive numbers, we're starting to see some inflation coming in different areas that are inherent in their sort of tariff story. So I guess that the story for the week ahead is going to be around inflation. Do you think inflation changes the picture, or do you think that the Federal Reserve look through it and ultimately say, we don't care, this is tariff-led, it's a short-term bump, and therefore we're just going to focus on a weakness in the jobs market?
No, I think, of course, inflation will affect the Federal Reserve decision because, as we said, or as we have witnessed during the last meeting, we have two inflation reports coming out and two labor market reports coming out before the next meeting. One inflation report and one labor market report is already out, and both of them is actually not good for the Federal Reserve. So they are, following the wait and see approach. The first two reports are absolutely against the Federal Reserve. So I think they are not just waiting for the next data, they are praying that the data comes in their favor. Hopefully, I personally expect inflation to start picking up more, even above 2.7%. And if in case we see more weakness in the labor market, so yeah, the Federal Reserve will have to take the hard decision of cutting interest rates in a period that we should have seen, fixing interest rates, but it's a decision that I think the Federal Reserve will have to take in the next meeting.
Yeah, I mean, look, it appears to be the case that more and more members are pushing towards a rate cut at that meeting. But who knows? We might be coming into that meeting, yes, with this data on the job side of things that sort of push things in terms of expectations for the Fed. But we might also be coming into it with inflation moving higher and higher, and suddenly this feeling right now within the markets doesn't really hold up. And I guess if we're talking about this in the context of, is our equity markets going to see some weakness going forward? Well, part of the strength we're seeing at the moment is off the back of the idea that we're going to see a more dovish Federal Reserve. And that isn't necessarily something that is guaranteed to hold up. And that's why when we're talking about the second week of August, well, that US CPI metric is going to be a really important one for traders to follow. Part of the interest within the US markets is the fact that they have these huge tech stocks that just keep going up, basically. Well, apart from Tesla and Apple to an extent more recently. And the concentration has only increased. You can see here 40% of the S&P 500 accounted for by the top 10 stocks. Now, if we're looking at it from a valuation perspective, the forward S&P price to earnings ratio is at roughly a 4-year high. That can't necessarily be said about mid caps and small caps. So a lot of that is driven by those big tech names. And then it comes around to the story around the justification for elevated valuations right now, in particular within tech. Of course, we've got the big AI story, but 6 out of the 7 Mag 7 names having now reported, by and large, most of them have come out very strong. We've seen a very strong performance for them alongside many of the other big tech names. Okay, AMD didn't do that well yesterday, but Palantir has done incredibly well over the course of the past week. So the tech story remains strong. And so when we're looking at valuations, the idea that we're at elevated levels, does that mean we're going to see a pullback? Not necessarily a guaranteed, but earnings ultimately power equity markets higher. As long as earnings are outperforming, then that gives us continued justifications for markets to go higher. If we see earnings underperforming, suddenly you see question marks around those price to earnings ratio valuations. So I don't necessarily think that we have that problem at the moment. And so when we're talking about the prospective things that might drive downside for markets at the moment, we've got the inflation story as one key element of it. The valuation story, I think, is inherently tied in with earnings. And I don't necessarily think that we've got any big sort of red flags coming from that side. So the US economy, are we seeing deterioration? And then the inflation side of the story. And part of that could become an oil story. Of course, we've got the whole discussions with Russia and the prospect of secondary sanctions on buyers of Russian crude. Let's take a look at the chart now and see exactly how things are shaping up in terms of the S&P 500 right now. And then we'll try and see exactly where we think we go from here and whether we do see this sort of consolidation, whether that could be short-term in nature, a wider retracement, or nothing at all.
Yeah, okay. So as we can see, this is the weekly time frame and the weekly chart on the S&P 500. And of course, the previous week was one big engulfing bearish candlestick. So this is basically just to start off, the technical analysis side. Things so far on the bigger time frame, on the weekly chart for me doesn't look so promising. And moving forward to the lower time frame, which is the daily, I'm personally a very big fan of momentum, price momentum, because it's one of the few leading indicators for price action. And as we can see, yeah, S&P has been trending higher since, let's say, the beginning of April 2025. However, we haven't had any decent price correction or a retracement during this whole period. Yeah, we have had small periods, a few days of a retracement, but I mean not a retracement that reaches at least 20% or 25% on the Fibonacci retracement. So this is why we clearly can see that momentum here is showing a very bearish divergence. And in this case, I can just say I'm expecting prices to move lower, especially during August, hopefully during the other part or the second half that you mentioned, because normally the first 2 weeks are quiet. However, the other 2 weeks, and of course, let's not forget about the Jackson Hole, which will take place and also takes place usually in August. So probably if any Fed comments are not in the favor of markets, I pretty much expect the S&P to move lower, and I will not be so pessimistic, let's say. And if we're looking at the Fibonacci retracement, so just a move lower to retest the broken all-time highs before, which used to be an all-time high back in February. That was a clear resistance. We moved higher, and I think we didn't have some good chance to retrace and test those levels one more time. So currently we're talking about the levels of 6,300. I think a move lower to at least, this is the bare minimum, to at least 6,100 points is something I truly expect will happen, especially during August. With all of the reasons that we have discussed, markets are slowing down for summer. Things are not looking so good for the Federal Reserve at the moment. Yeah, maybe prices are overly expecting that the Federal Reserve will do one decision or another in the next meeting. But in the meantime, I think this move could take place in August. This is what I personally see when it comes to technical analysis. What do you think about this?
It's interesting stuff. I mean, like we've highlighted, there's a number of hurdles up ahead, a number of different things that could throw us off. There's a lot of uncertainty. We don't know how weak that economy is. We don't know how much inflation will rear its head. And coming into a month that, like we've said, historically isn't a great time for markets, coming off the back of a great time, you can see we've seen a very strong rebound from those lows. Yeah, it's a possible time for people to be either taking profits or looking for potential areas where we could come into. It's worthwhile noting that the trend is our friend, and the trend generally is upwards for this market. And so, when we're talking about potential pullbacks, we are both very aware of the fact that that is set within a historically very bullish market. So I generally try not to go against trends. I generally sort of try to wait for retracements and then get into that trend. So different ways that people are looking to play it. But
it's just looking
really,
for buying opportunities to ride the whole overall trend, right?
Yeah, exactly. And like I always say, you don't need to take the absolute top and sell and find the absolute bottom and buy, but being able to get portions of trends always is more attractive to me. Anyway, that's enough for today. Like I said, we'll be making more videos like this, covering all sorts of different topics as they come up. Thankfully, we've got Donald Trump to keep everything interesting in our jobs. So there'll be plenty of more video content like this, covering all sorts in the future between myself and Mohanad. Thanks for tuning in. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Mohanad here, Senior Market Analyst at Scope Markets. Thanks for joining us. Like, subscribe for more content like this. Cheers, guys.
Thanks, Josh.